that's what we're really excited about, is giving access to a brand new asset class that people didn't have access to. There's other models out there that are similar where people can invest in art or wine or whiskey or, collectibles, that type of thing. And we're just simply providing that access to the internet, to online businesses in that same way.
Welcome to your daily real estate syndication show. I'm your host, Jim Pfeifer from Left Field Investors, a community dedicated to educating LP investors and providing a network and access to deals. I'm sitting in today for Whitney Sewell, founder of LifeBridge Capital. Our guest today is Kyle Kuderewski. He is the operations manager at Webstreet, an investment platform that allows people to passively invest in online businesses and digital assets. In this episode, we talk about the importance of developing a personal passive income machine and how digital assets can be part of that. We talk about what digital real estate is and how to analyze an operator and an investment in a digital asset, and then the outlook for this asset class in 2024. Kyle, welcome to the show. Let's start out with who you are and how did you get to where you are today?
Hey, Jim. Thanks for having me. Yeah, I've listened to the show for quite a while, so happy to be joining. My name's Kyle Kuderewski. I'm the operations manager with Webstreet, which we can get into what we do. But personally, I'm like what I like to call an engineer turned investor. So I went to engineering school, did my master's in engineering, got into the corporate America world, and eventually, wanted to start to generate a passive income machine. I got into real estate investing as well. I do some vacation rental. Yeah, I own a small vacation rental business that I kind of run on the side. And then, I got into the online business world about 3 years ago. I was pretty fascinated by what online businesses and digital assets can offer. And, so I've been building Webstreet ever since, allowing investors to passively invest in online businesses. So that's where I'm at. On the personal side, I love to do anything active, snowboarding, triathlons, just being outdoors, hiking, and just to enjoy life. So that's a little bit about me.
Awesome. Well, thank you for that. I think we would start out with, Webstreet allows people to get into, digital real estate in the form of these websites, Amazon stores. Can you just tell us what that is? Digital real estate, talk about all of it, like just introduction, low level, because a lot of us don't really understand. I mean, we know what a website is, we know what an Amazon store is, but just kind of dig it out for us, what we're talking about here.
Yeah. So, digital real estate is the perfect way to put it. So online businesses, digital assets, any type of business that doesn't have a physical location. So if you think about, if you want to keep the analogy going and compare it to physical real estate, you might have multifamily, single family, vacation, commercial, different types, right, of real estate. So in the online business world or digital real estate world, we have general websites, so content websites, top 10 sites, review blogs, that type of stuff. We have Amazon FBA, so sites that anytime you're on Amazon and they're fulfilling a product order for you. We have Kindle sites where if you're ordering books and things like that. SaaS is a huge one for us. So software as a service, any of these recurring softwares you use, Zoom is a huge example, but Slack, on and on. Any of these things that you sign up for a subscription model and pay a recurring service, that's a SaaS. So that's a type of online asset we do. And then there's many others as well. There's apps, just apps on your phone, which can be a SaaS or just a standalone one-time purchase. Yeah, so there's many, many different models, and we provide investors access to a lot of those asset classes.
And how do you provide access? Can you talk about that? You have people that go out and buy these businesses, and then the investors would own a piece of that specific website or that specific Amazon store. Can you talk about what exactly are we buying?
Yeah, great question. So in the past, there's several brokerages out there, Empire Flippers, Quiet Light, Flippa, many brokerages where people could go buy a website or any of those asset types of sites that I just talked about. They would have to run them, right? They would have to build a team. They would have the skill set to do it. And until recently, there was no way for people to passively invest and take part in the upside of online businesses. So we created Webstreet, where we pair investors with online business operators and some of what we like to say, some of the best online business operators or portfolio managers out there. So we use that term kind of interchangeably, operators and portfolio managers. But we go out and find those operators, we vet them, we figure out their track record, and then we bring investors on board. So they invest, whatever fund size. It's a syndication type model. So it's an SPV, a fund, and investors invest, those operators go out to those brokerages that I just discussed. They lay out their acquisition criteria ahead of time. So generally what you're investing in. What type of business you're going to invest in. If it's $1 million fund, $2 million fund, et cetera. And then they go out and they use the investor money to purchase websites or apps or whatever those assets are. And a single fund can contain 2, 3, 4 different sites. And once they purchase those, it'd be just like purchasing an apartment complex or something like that. They start to either grow the websites, implement their growth strategies, bring their teams on board and cash flow those websites. So that whole process takes 6 to 9 months from the time the money's raised to the time that they purchase these businesses and start to grow them. After that, the way our model works is we give quarterly dividends to the investors. So 2/3 of the profits every quarter get distributed back to investors, and 1/3 goes to Webstreet and the operators. They don't get a salary, so that's the only way they make money, and the only way we make money is if the investors make money and the businesses are growing and cash flowing. So that's one huge part of these assets is you're not simply waiting on them to appreciate. They're already cash flowing assets. And if they grow them, they appreciate. In the 2 to 4 year range, they're going to sell those assets and we'll then distribute those profits on the sale as well. So bit of a long-winded answer there, but I hope those analogies kind of clear it up.
Yeah, that helps for sure. So let's say one of these online business operators, they go out and they buy, for example, a website. So presumably that website has some content that's being generated by the current owner. Maybe it's a small, like we talk in multifamily or self-storage, it's a mom and pop operator, right? And so who then, do they hire the people that had the website before to work for them? Or who's providing the content? Who's making sure that the website is still operating the same way it was before? Can you talk a little bit about those details?
Yeah, that's a really good insight. And I hate giving this answer. The answer is it depends. Generally that is the case. So during the negotiations, they may say, okay, I want to keep, you're either the owner or the owner's team on for 3 months, 6 months, a year or whatever to help that transition and continue to generate that content. Sometimes they'll hire them full time. So they purchase, them as an employee, I guess would be the best way to put it, when they purchase the business and they stay on full time for however long. Sometimes they don't want any of that. Sometimes the operators, they already have their own writers in place, their own technical people on their team, and they just want to, start fresh and implement their strategies. So it depends, but it is very common for there to be some overlap from the previous writers or technical people and that type of thing. And, generally, depending on what the niche is, that's super important, right? Like if it's a jewelry website, they may have an expert in the jewelry field that you want to continue to write about on your site. Maybe 3 months, maybe 6 months, maybe, indefinitely. So, the answer is it depends, but generally there is some overlap.
Okay. And this is less real estate and more operating businesses and maybe digital real estate because they are taking up a space on the web. But how does this help? Like, we're used to talking about real estate, actual, real estate, multifamily and all that kind of stuff. So how does an investment like this help a passive investor in real estate diversify? Like clearly you're getting into something new, but how do you balance that out with your other passive investments?
Yeah. So, the key, generally the key is diversification, right? So if you've already got a ton of exposure to real estate and you believe in that the internet is only going to continue to grow, and these models are only going to continue to grow as AI grows and that type of thing, then it's a really good way to get exposure. Now, everybody has to decide their own, their own risk profile. You want to understand what you're investing in. If you believe that Amazon FBA is here to continue to grow, then you probably want to invest in that operator versus, maybe a content or affiliate operator. Generally, we package these together in funds. And so you automatically get diversification across our different asset types, but you personally have to decide, like, am I 75% real estate, 25% online business, or, whatever, 25% stock market, et cetera. But that's what we're really excited about, is giving access to a brand new asset class, that people didn't have access to. There's other models out there that are similar where people can invest in art or wine or whiskey or, collectibles, that type of thing. And we're just simply providing that, access to the internet, to, online businesses, in that same way. So we've been doing it for about 2.5, 3 years now. We've got, about 40 million under management, 30 plus businesses under management and delivering really solid returns. Some of them have grown a lot, some of them have declined, and some of them have stayed steady. So you can find all that information on our website. We've got case studies and on and on. And I definitely don't have time to, go through all the funds today, but it's all on our site, and we encourage you to go check it out.
Okay. And then, continuing on this, compared to real estate, because we got to compare it to something. And I know this is going to be a very broad question, but if we're looking at the risk level and volatility of these web businesses compared to, the standard real estate that we're talking about, self-storage or multifamily, is this more risky? Is it less risky? Is it more volatile? Can you talk about that a little bit more in depth?
Yeah. I mean, generally speaking, it's just Kyle's opinion, probably a little bit riskier than just a traditional single family home, right? Because, while there's things in in real estate that are out of your control, weather events or maintenance things and that type of, what's going on in the community, like there's similar things out of your control in the online business world. So Google updates, Amazon updates to email clients, ad blockers, that type of stuff. But all of that being said, the operators that we bring on have been through many of Google updates and many Amazon updates and many, they've seen the internet evolve and they adapt their strategies. So when something changes, it's not always the case that they can change and adapt, but generally speaking, that's what we're looking for. People who have done this time and time again and have a track record of being able to overcome those variables. So that does make it a little bit riskier. I mean, the internet changes faster, I would say, than real estate. But, if you look at something like commercial real estate, and the way COVID affected that, like nobody could have predicted that as well, right? So it's kind of hard to quantify, but, there's similar risks.
And so I'm a passive investor, right? Mostly in real estate, as we talked about. And when I'm trying to look at a new investment, I analyze the operator and then I vet the deal. What are some things to look for when I'm deciding what online assets to purchase? I mean, I use websites, I buy stuff on Amazon, I use Zoom and some of these other things, but that doesn't, just like, when I started real estate, I'd lived somewhere before, but that doesn't qualify me as someone who really can analyze the investment and determine whether it's something I want to get into. So am I analyzing and vetting Webstreet and you, Kyle? Yes, but then what about the operator below you? So how does a passive investor kind of get their arms around this and figure out what am I looking at and how do I determine what assets I want?
Yeah, that's an excellent way to think about it. So, at the top level, you are trusting Webstreet. You're trusting our track record. You're trusting the way we do our due diligence on operators. And all of that information is, readily available. The information about our team and, how much online business experience we have, you can find all of that. But then if you take it a step lower, when you look at our fund pages, you're going to want to dig into each operator's track record. What are they looking to buy? How much are they looking to raise? We do operator interviews every time, so about 20 to 30 minutes where you can hear it directly from them, what their growth strategies are. And then the other part that I would hit on is the way our model works. We want to bring back our operators over and over. So they come on, the fund we're opening, January 2024, like next week, we're bringing back an operator for the fourth time. So he's got quite a track record. Investors want to continue to invest in him. And so if we're not going to bring back an operator that hasn't performed, so that's a pretty clear indication that we have trust in them. This is not a guarantee, of course, but it's a pretty good indication. But kind of tying all that together, we generally don't recommend coming in and just picking one operator because it's kind of like throwing a dart at a dartboard. I would diversify across several monetizations, across several operators, and that's probably the best way to do it unless you have some really good knowledge or expertise on why you may want to get into a specific fund or not want to. So I hope that helps clear it up. There's definitely a trust level there, but like I said, you never want to just invest. This goes for real estate or anything. You never want to invest without understanding exactly what you're getting into, right? So,
right. And talk more about the fund then. Is each fund a separate operator? And so I can look at that and say, okay, I know this operator generally buys websites and a few Amazon stores, and this other operator does, software as a service and maybe some apps, and there's a different fund for each. And yes, let's forget about diversification just for a second. We're just talking about how do I decide, yes, I want to do this website thing and the metrics here are better and I have a better chance of making money, and then compare it to the one that's doing a different fund that's services or software as a service. I think I asked 3 questions in there, so I apologize. I'm just trying to wrap my head around it a little bit.
No, it's perfect. There's a point I need to hit on. So when we first started out, each fund was one specific operator, and each operator would go buy 2 or 3 businesses depending on their criteria. What we found is that our investors that were picking individual funds, their overall returns were generally much lower than those that were investing across all the funds in a round. So recently, at the end of 2023, we adjusted our model to where it's one single each time. Like right now, we're opening our 7th fund. That fund is an individual LLC with 3 different operators in that fund. So if you want to invest in this round, you get exposure to all 3 of those operators, and each of those operators is going to go buy, say, 2 to 3 businesses. So you're getting access to all, let's just call it 9 businesses in that portfolio. Now, we know that's not everybody's favorite model. They may not like one of the operators in this fund, so maybe they want to sit this one out and wait for Fund 8 or Fund 9. But generally speaking, we know based on our data that this is providing better returns for investors. So that's why we've changed the model that way. So it's still encouraged due diligence. Like if you don't believe in Amazon FBA or a certain, you don't want to get into SaaS, then sit the fund out and come back and look, sign up for our platform. We'll update you. We're doing funds every quarter pretty much right now. So is that clear on how the structure is? It's one diversified fund with multiple operators.
Helps. It's kind of like a blind fund, right? Again, comparing everything to real estate, because I'm not going to know exactly what assets are going in there. I'm going to kind of know the asset class, meaning, okay, this guy likes websites, this guy likes Amazon stores. So I know that, but I'm not going to know the details. So it's similar to a real estate fund. How would you compare this to like the fund of fund model in real estate syndications where somebody's raising capital? Can you kind of compare it to that and kind of analyze which characters are which, I guess is what I'm trying to say.
Yeah. I'd say, you're spot on. It's very similar. And, we definitely have, we're always looking to line up incentives, right? So we've toyed with the model of trying to identify businesses first, and then letting people invest. I don't know that I don't say we would never do that, but there's a lot of reasons that we're not doing that currently. This fund-to-fund model, it allows us a lot of things. So if we raise, our previous fund, we raised $6.3 million, okay, for 4 operators. So they're out there making their acquisitions now. What's really nice about that is there's $6.4 million in cash ready to deploy. So we can get these businesses at really, really competitive multiples compared to an individual out there. So we can negotiate really well. The other thing is, we have a lot more flexibility because it's on a $6 million fund. It's not 1.5, 1.5, 1.5, 1.5. We have some discretion on, okay, this operator found a great $2 million business, or this operator found a great $500,000 business. So it gives us flexibility in both our acquisitions and negotiations. And then the last thing I should hit on there, because I said the operators don't have salaries. The operators actually put in 5% of their own money into every one of these funds. So each of however much they acquire, 5% on a $2 million acquisition, they've put in $100,000 of their own money. So they really, really have skin in the game on the acquisitions that they're making. So, very similar to the fund-to-fund models. And those are the reasons that we built it that way and aligned incentives.
And the operators are coming to you because they can't cut a check for $2 million, or they can't find their own investors to get to the $2 million. So they're willing to give up 2/3 of the profit on these businesses to be able to, essentially get their deals funded.
Exactly. It's a way to level up. All of these operators have had very successful exits before. So they have funds, but maybe not enough to do a $2 or $3 million business. And we only want to grow. We only want to, do bigger and bigger acquisitions. The other part of it is, one of that operator that I mentioned that's on his 4th fund with us, he previously did do his own fund. So he got his own investors, and he's just found that he would rather go through us, and not deal with taxes and investor relations and distributions and all of that stuff. So yeah, it's it's a model that we're very happy with right now. We'll continue to adjust, based on returns and investor demand and operator demand. But that's where we're at right now, and we're pretty happy with it.
And who do the operators sell the businesses to when it's time to sell? And why would they sell if it's cash flowing? I mean, maybe it's the same as real estate, right? It's cash flowing, and you sell it to somebody, and then you get a big capital return. So why do they sell, and when do they sell? And to whom?
Yeah. So we generally say 2 to 4 year range. It would never be in less than a year, just from a short term capital gains perspective. I'm sure you and the listeners understand that. It's a good question. A lot of times, if they're sitting there cash flowing but they haven't grown, I guess it depends on a lot of factors, but like how their team's doing with workload, what they think of the niche. Are they seeing the business start to decline? Maybe it grew a lot and they're starting to see it trend down a little bit, so they want to go ahead and offload that asset. Generally, they would sell. When we first started, we only worked with the Empire Flippers brokerage, which was one of the larger ones. Now we are open. We're basically broker agnostic. So we work with any broker, and we also do private deal flow. So the answer is who would be, anybody that was with one of these brokerages or wanted to acquire one of these sites. So a lot of people out there, Empire Flippers, like I mentioned, they're just one of the brokerages. But in their existence, they've brokered over $500 million, over $500 million in sales. So there's a lot of people out there looking to buy quality assets. And generally, that's what we're trying to buy, right? Is quality assets, grow them. And then, the next person that purchases them, has a quality asset, ready to run. So, kind of hard to define exactly who, but there's a lot of people out there looking for online businesses, especially quality ones. We have a few assets for sale right now. So beginning of 2024. Like I said, we've only been around 3 years, so we are starting to build a track record, but we're just now having our first exits. So we have our first full cycle. So we're always discussing with the operators, like, is this a good time to sell? Do you think you could continue to grow it more? Or have you already, got all the growth you can out of it? So again, sorry for the long-winded answer there. There's a lot of different asset types. But it's generally a conversation between us and the operator on where we think the asset's at in the life cycle of that asset.
And do they, again, I'm sorry, but I'm comparing everything to real estate because that's what I do all day. Are they adding value? Like, in an apartment, you turn the apartment and you upgrade it to gold star class or whatever. Are they doing the same kind of things where you take an asset that maybe needs some work, it's doing well, but man, if you could just do these 3 or 4 things, it's going to really accelerate? And then do they also use maybe their other online businesses to work those together so they can grow all of it? Can you talk a little bit about that?
Yes, 100%. It's a great analogy. So they're always looking for synergies, right? If they have multiple of sites in the outdoor niche or the pet niche, it can be very beneficial. So things that they do to improve, like a content site, for example, would be something that's called backlinks. So linking to other websites in the same niche or different niches really helps you rise the search rankings on Google, which is a big thing, right? So SEO. Search engine optimization, improving that through backlinks, through quality articles, through keywords, etc. That's something that a lot of our content operators do. Advertising, we make a lot of our sites make money through ads, right? So improving Amazon ads, improving affiliate ads is another way that they make those improvements. And yeah, you're spot on with the synergies thing. So if they have multiple sites, their team might already be expertise in pet writing, right? So it's that much easier. They can add new products. If it's an FBA site, they can improve their page listing and improve their revenue by adding new products, developing new products. So all of these operators, even if they're in the same monetization, they typically have different strategies for how they're going to grow them.
Okay.
Or improve them, to keep the real estate analogy going.
Yeah. You mentioned taxes. Now, I assume these don't have the same tax benefits that real estate have. So can you mention how you call them dividends, but the cash flow during the operating business while we're owning it, how is that taxed? And then at the end, when the business is sold, how is that taxed? And just a caveat, you're not a tax advisor or CPA, but just your opinion of what you've seen.
Yeah, so that's it. You're right. It doesn't have the same tax benefits as real estate. What we do have is basically for each fund, you get a K1 each year, pretty standard stuff. And the depreciation is a 15-year straight line depreciation. So there is depreciation. And that can vary depending on the type of site, right? If there's a bunch of inventory for Amazon, it's depreciated differently than a content site. But for American individual, we have investors with LLCs, with trusts, with IRAs, that type of stuff. It's just standard 15-year straight line depreciation, no withholding. And like you said, every quarter at the end of Q1, it takes us about a month to close the books and do all the P&Ls and everything. We have a third party that does all of that, so it can be audited and it's all very transparent. And then we make those distributions. They go to your Webstreet wallet. You can leave the money in there. You can reinvest it, or you can pull it out into your bank account. It takes, a day or two.
Excellent. So let's dig in real quick to the outlook for online assets in 2024 and beyond. Are there, industry trends, AI, what's that going to do? What are the risks? Can you just kind of talk about how you see 2024 and maybe into 2025? How do you see that panning out in this space?
Yeah, so generally, I'll hit on a couple different things we've seen with monetization. So FBA, which is again fulfilled by Amazon, had a huge boost during COVID. I think everybody can pretty clearly figure out why. So that's flattened out and declined some. So we've taken a step back at this moment from FBA. We still have a bunch of FBA assets in our portfolios that are performing well. But right now we're taking a little bit of a step back and seeing what happens there. Content continues to stay steady. There's not a ton of growth there, but it's definitely not declining. That's affiliate ads, all that stuff. People still love to go read from industry experts before they make purchases. I mean, I think that's more and more common. Top 10 travel backpacks, et cetera, et cetera. So we're still very much, pulling content into the portfolio. The thing that that we're really bullish on is SaaS. Let me take a step back. The only thing I should have hit on content is everybody's kind of holding steady and seeing how AI affects content. Obviously, you can go to ChatGPT or one of these other tools and you can crank out content much quicker than you could before. What's not super clear yet is how Google and other search engines are going to rank that material, because they generally are pretty ahead of the trends. If you're just cranking out kind of chunky, not quality articles through AI, it's probably not going to have the benefits of a well-written article. But it doesn't mean that AI tools aren't going to affect the industry, because obviously they are. And then on SaaS, we still continue to see tons of apps and different SaaS tools coming out all the time. And often the newer tools, where they're kind of disrupting the industry versus legacy older tools, have an advantage because they can pivot quicker and they can just take advantage of new technology. So we're very bullish on SaaS. Our current Fund 7 has 2 SaaS operators in it. Our Fund 6 had our first SaaS operator. And then the last one continues to, Kindle Direct Publishing continues to do pretty steady as well. And that's not nearly as competitive as the others. So you can get a lot of good, assets in that monetization at good prices. And we've had success there too.
Excellent. This has been a fascinating conversation. Very interesting. Appreciate you. If listeners are interested in learning more about what you do, what's the best way they can connect with you and learn more about Webstreet?
Certainly. So it's webstreet.co, not .com, .co. And my email, I'm very active on there, is kyle@webstreet.co. I'm also on LinkedIn, Kyle Kuderewski. You'll have to look up the last name on the title here to spell it. But please feel free to reach out. I connect you with our investment advisors, see if it's a good fit. It's not a fit for everybody's portfolio, but we are excited to give access to people who want to diversify and learn more about the asset class. So please feel free to reach out, and look forward to connecting with you.
Awesome. Well, thank you, Kyle, for being on the show. We appreciate you.
Awesome. Thanks, Jim.
Thank you for listening to the Real Estate Syndication Show. It has been a pleasure to be the guest host today. If you would like more information about left field investors and how we educate limited partners, provide a network, and give access to deal flow, please visit leftfieldinvestors.com or reach out to me directly at jim@leftfieldinvestors.com. I hope you learned a lot from the show today. Please don't forget to like and subscribe and share the Real Estate Syndication Show with your friends so they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.